Clean Energy Finance Policy Analyst in ACEEE's State Policy Program. I want to take a moment to welcome everyone back to Day 2 of 2021's Energy Efficiency Finance Forum. I hope you found yesterday's keynote with Jigar Shah, as well as the plenary discussion with Kim Earl and Jahi Wise, as timely and thought-provoking as I did. And if you participated in the Energy Efficiency Financing 101 workshop, we hope you found your participation rewarding and the information shared beneficial to your work. After you attend your last live webcast today, we ask that you please complete the Finance Forum survey link on the Engagement Hub webpage. What you gather from the survey responses is incredibly important in developing the format and program of next year's Finance Forum, which will be held in White Plains, New York, May 23rd through 25th. Today, you will have the opportunity to join 3 of the 6 concurrent sessions being presented live. Any sessions you miss will be available to view on demand within the next few days. And now, I'd like to introduce Jeffrey Shub, Executive Director of the Coalition for Green Capital. Jeff will be your moderator for that upcoming session. Green banks have mobilized over $5 billion in clean energy investments. What has been the efficiency impact, and what is the outlook?
Great. Thank you so much. Really a pleasure to be here. Pleasure to join ACEEE once again for the Finance Forum to be able to discuss the progress and the prospects for green banks around the U.S. at the state level and now today at the federal level. Really excited about the timing of this discussion. There is a surge of interest and development of green banks across the country. There is also pending federal legislation to create a national green bank. So now is really the perfect time to discuss how green banks actually have now mobilized $7 billion of clean energy investments because the 2020 data has come in the intervening weeks since the creation of this panel and the release of the annual report. So we'll dive into that all together in this discussion with our incredible panelists. First, just a little bit of housekeeping. I want to start with a few points about how the session will run. As a reminder, your screen is customizable using the various widgets found at the bottom of your screen. Presentations can be downloaded as PDFs from the resource list in the menu. Attendees are in listen-only mode, but can submit questions through the Q&A box anytime during the webcasts, and presenters will be answering questions following the presentations. All webcasts will be available for download on-demand viewing within a few days. And then Zoom discussion rooms will be open at the end of the webcast to continue the conversation and allow for additional questions. To get there, just click on the Zoom widget on the bottom menu or download the daily Zoom link PDF available on the Engagement Hub. Also, please be sure to complete the evaluation form after your last webcast and receive a $25 credit towards the 2022 Finance Forum event, as your feedback is quite helpful to the ACEEE. And lastly, we want to thank our sponsors and partners for their support of the Finance Forum. I want to introduce now our panelists to you all. I'll give more detailed bios before each of them speaks, but I'm really thrilled to be joined by 3 close colleagues and friends in the Green Bank movement: Mary Templeton of Michigan Saves, Bert Hunter of the Connecticut Green Bank, and Tom Deo of the Montgomery County Green Bank. All 3 of are leaders of tremendous stature in this space and are doing incredible, innovative, boundary-pushing work to expand access to clean energy and energy efficiency finance, using public capital in innovative ways to expand and increase private co-investment, and are specifically increasing access for low-income and disadvantaged communities in ways that are significant to ensuring a equitable and just transition. Before turning to our speakers and our panelists to learn more about their work, I'm going to take the opportunity to brief folks on the situation at the federal level, because as anybody who's reading the newspaper knows, there is a major effort underway at the White House and in Congress to pass some form of infrastructure legislation that would have trillions of dollars of spending, very likely including spending on clean energy investment in various ways. And we're at a key juncture in that point and want to take the time to just brief folks quickly on that situation. So as the slide shows, the name of the federal legislation that would support the expansion of green bank financing across the country is the Clean Energy and Sustainability Accelerator, or Accelerator for short. This legislation was most recently introduced just in this session of Congress to fund an independent nonprofit green bank called the Clean Energy Accelerator, with a funding level of $100 billion. This builds on a long federal legislative history going back to 2009 when the first bill was introduced, which garnered bipartisan support. The current proposal passed the House of Representatives twice last year. It has bipartisan support in the House this year. It was expressly included as part of the President's American Jobs Plan, called out by name, that was introduced on March 31st. And it was also specifically included in the President's counter proposal to Republicans as part of the ongoing infrastructure negotiations just last Friday. So this is a topic that has quickly become a top priority of many leaders in DC. What is a green bank? I think folks are probably increasingly familiar with this, but as this graphic shows, green banks combine $1 public dollar of money with $3 of private investment on average to drive catalytic investment into clean energy solutions, including building efficiency. And this leverage ratio has borne out over time through the actual experience of green banks that you'll soon hear from. There are now 21 green banks in 15 states in the district, which over the last 10 years, as I said, have now driven $7 billion of total investment, using less than $2 billion of public green bank capital to cause that investment. And as you can see here, the map is expanding into states that are not traditional blue or democratic states. And if you look here, even more so, you see this spreading much more quickly in all corners of the country, where there are now 22 more states on the pathway to green bank creation. This includes the Republican governor of Alaska, Mike Dunleavy, introducing legislation last month to create an Alaska green bank. This includes bipartisan legislation in Maine, bipartisan legislation in Illinois, bipartisan legislation in Minnesota, legislation that recently passed in Virginia. This is growing very quickly, and it's for two primary reasons. One is the proof over the last decade that this model works and is effective, and you'll hear the details of that from the panelists, and also folks seeing the federal legislation coming down the pipeline to finally solve the #1 barrier to green bank expansion across the country, which is where is the capital going to come from to actually seed the institutions to start investing, and that's what the accelerator would do. The accelerator would specifically expand this green bank network across the country, developing local solutions for local problems. It would engage private investors, utilities, and contractors, just as green banks do today, and would definitely work very closely with mayors and city councils, again, focusing on local solutions for local problems, as this is not a one-size-fits-all financing challenge across the country. Just showing a little bit about the nature of the problem that's to be tackled here. I think everybody probably knows this, but sometimes it's helpful to see it, that electricity is the one commodity in the country that varies widely in price state by state. A box of Cheerios is more or less the same price everywhere in the country. That is very much not the case with electricity. And when you compare that electricity cost to the variation in household income, you see that the energy burden, the household energy spending as a percentage of income, does also vary widely and disproportionately across every single state in the country, hence the need for state-specific solutions. And then importantly, from a climate perspective, again, I think folks know this, but seeing it on a map sometimes makes it quite clear that the sources of emissions vary from state to state, and the emissions intensity vary from state to state. And so you put these kinds of maps together along with maps showing where energy job opportunities are, energy transition impacts might be felt, and where the health impacts of the current carbon platform can be felt, and you realize what you need is a national funding source for state and local solutions, which is really what the accelerator and green banks are meant to accomplish. The proposed $100 billion accelerator would leverage over a decade about $800 billion of private co-investment, yielding nearly $1 trillion of total investment, which would in turn create about 4 million jobs in the next 4 years. And these jobs span a wide range of skill sets and job types. We've done a lot of work with green banks across the country to understand the jobs that are actually being created. And as you can see in the pie chart, these are jobs that are good paying jobs in technical fields, as well as sales and management and administrative jobs as well. A critical component of the accelerator and what green banks are doing today is to ensure, as the United Mine Workers of America recently said when they effectively endorsed the president's plan, we need to have a true transition and a just transition for all Americans who can enjoy the economic benefits of a transition to a clean energy future, which requires targeted, specialized investments into specific communities. if we let sort of the forces, sort of market forces on their own drive this investment, I think we've already seen in the last year have had a much greater awareness of the inequity of how that investment falls and where the benefits and harms of our energy system might fall. The accelerator is specifically required to invest 40% of its investment into disadvantaged frontline and low-income communities, and will do so in a targeted manner through networks of state and local green banks and with private partners. Overall, the accelerator will drive about 20% of the necessary emissions reductions to get to net zero by 2020, and it is the largest single climate reduction program on a per dollar basis in the American Jobs Plan. Obviously, the entire American Jobs Plan is significant. It's over $2 trillion, but on a bang for buck perspective, this is the most significant policy. And so that, in a 5-minute nutshell, is the status of the federal legislation and what the accelerator proposal is. I'm not going to prognosticate and try to read tea leaves on the political machinations in DC, but it does seem quite likely that a bill, including energy infrastructure, will pass the U.S. Congress this year. It could be bipartisan. It could be through budget reconciliation. If folks really want to get into that, I'm glad to. But at this time, I'd love to turn things over to the panelists who can tell you in more detail what the green banks are doing and accomplishing in the efficiency space, to give you a sense of the kinds of benefits and the kinds of activity that can be brought around the country if there is federal policy. And so now I'd love to first introduce in more detail our first speaker, Mary Templeton. Mary is a fantastic partner and friend of CGC and the entire green bank community. She serves as president and CEO of Michigan Saves, a multi-million-dollar nonprofit green bank whose mission is to stimulate and support investment in energy efficiency and renewable energy systems in homes, businesses, and public buildings. Whether she is serving the board of directors, designing new offerings, facilitating strategic planning discussions, managing financials, or fundraising, Mary works hard to achieve mission-aligned results through cooperation and collaboration. And with that, I'm very happy to turn it over to my good friend, Mary Templeton.
Thank you so much, Jeff. I really appreciate it. And we're really excited about the possibilities that that an accelerator or a national climate bank funding would provide for Michigan and for all of us around the country. As Jeff said, we are Michigan Saves. We're the nation's first nonprofit green bank, and we were set up to address financing gaps to accelerate energy efficiency in all kinds of buildings. What I want to talk about today is how we have used a loan loss reserve to attract private capital. Jeff talks about leveraging the public investments with private capital. We've built our program on that strategy, and that's what I want to talk about today, hoping that I can offer some lessons learned from our experience over the last 10 years in building these programs. My focus today is going to be primarily on our residential program, but at the end, I'll cover a few comments that I have around using what we've learned about using a loss reserve on the commercial side. So let's start out with a little bit of background. When we were first created by the Michigan Public Service Commission back in 2009, once again, we were created to break down barriers to people being able to finance energy efficiency and renewable energy improvements. Michigan had just created our first energy legislation in some time that required the utilities to hit energy efficiency goals as well as renewable portfolio standards. And the Michigan Public Service Commission in the state of Michigan realized that in order for the utilities to hit those standards in Michigan to reach our goals, we were going to have to provide some kind of mechanism for people to be able to afford for them to make investments in their homes and businesses. We had funding from the commission in two forms. One is to get us started, brand new organization, do initial stakeholder outreach, and the other was a credit enhancement. There was $6 million granted to us, specifically designated as a credit enhancement. Our goal was to serve the entire state. So we knew, looking at that $6 million, we have 4 million households within the state as an example, and plenty of commercial buildings. We knew we wouldn't be able to serve every single Michigander if we did our own lending. So we looked at different options. We did stakeholder outreach. We talked to lenders. We talked to contractors. We talked to all types of stakeholders, whether they were nonprofit organizations, homeowners, business owners, state employees. And we found that there were plenty of lenders who really wanted to lend, and there were contractors that wanted to do the work, but there wasn't anybody putting it into some kind of a program that served the unique needs of energy efficiency and renewable energy. So in our research, we found that there were many advantages to using a loan loss reserve specifically, especially for a brand new organization as we were getting started. We could use the lender's money, for example. We could use their resources. Lenders had plenty of on-deposit capital to lend, but they weren't doing so in a way that matched the needs of energy efficiency. So if we could insert some pressure by giving them, helping mitigate their risk in the form of a loan loss reserve, that helped them expand access to individuals that wouldn't otherwise qualify, expand their terms for unsecured loans that the contractors told us they really needed unsecured loans so that they could close those loans in the business or home, in, like sitting at a kitchen table. At the time, it was 2009. People did not necessarily have equity in their homes, so a home equity loan was potentially out of the question. And sometimes when people were replacing their equipment because of a break, like their furnace broke or their air conditioner broke, you needed to have immediate access to capital. Otherwise, they were going to not invest in the highest efficiency equipment. In addition, the lenders had the processes, the people for lending activities like origination and servicing. So we didn't have to set up those systems, and we didn't have to hire resources to be those lending experts. And lenders could offer programs that really matched our needs, and we shared the risk with those lenders. The other thing that having the lenders do the origination and servicing, the lenders had those consumer protections built in. So we didn't have to worry about that. The lenders had all of those consumer protections built in, especially as we were looking at serving underserved markets. And just to note about the lending program that we originated, or that we set up, it is all unsecured loans on the residential side. And that was really, really important to the stakeholders because they're fast. Like I said, they didn't need equity in their homes, and you could finance 100% of the project. So how does it work? What we do is we set aside 5% of the lender's outstanding loan balance every single month. So we rebalance every single month. We take 5% of their outstanding loan balance, and we set that aside on our balance sheet specifically for that lender. So for example, if a lender has $1 million in outstanding loans with us, we'll put $50,000 on our balance sheet that they can claim for default as they occur. When a default does occur, what we have outlined a default to be is somebody who has not made a payment in 90 days. They can claim that loan. What they can do is claim 75% of it. So it is not a loan guarantee. We're sharing the risk. We pay 75% of the outstanding loan balance. We pay up to the amount of what they have in their pool. So, for example, in my example of $1 million in outstanding loans, we've got the cap of 50,000. They could claim 5 loans that have defaulted up to $10,000 for each loan. That balance keeps adding up. So the 50,000 keeps growing as they grow their loans with us. So it really incentivizes those lenders to close loans each month and grow their portfolio with us. Another thing that I should mention is that the lenders continue collecting as if they don't have any kind of a payment from us or a loss reserve with us. And we have seen many times that a customer does resume payments, and when they do that, the lenders pay us back the money that we paid them, and that goes back into their loan loss reserve. So what does the lender program, the residential lending program, look like? All of our lenders, we have about 8 or 9 of them, are credit unions. We found the credit unions to be really eager partners in this space. They set their own rates. up to a max. We have a max of 7%. But the customers do select their lenders, so the lenders do end up offering really competitive rates. The customer can see what other lenders in their service area offer when they're applying for their loan, and so they can choose their credit union based on where they live, work, or worship, and they can see what rates they offer. So the lenders really end up being competitive with their rates. Right now, they're offering fixed rate up to 15 years, right around 4%, 4.25%, up from $1,000 to $50,000, all unsecured loans. And we have some lenders looking into solar financing for up to 25 years. That solar financing will be secured with a UCC filing. We do offer the underwriting criteria is our credit scores go as low as 600. We do offer the lenders the opportunity to take a second look at each one of the applications that is denied, and if they can find a way to finance them, even if they fall outside of our underwriting criteria, we allow that to occur. We're really looking to serve as many homeowners as we possibly can and open up access to those that don't necessarily fit in standard underwriting criteria like the 600 credit scores. Our debt to income ratio is very expansive. It's 50% or less. Really fast, really easy process. We've improved that over the years, and we're now able to approve the loans in just a matter of minutes so that the contractor can close the deal, schedule the work, order the equipment, and make the improvements. Since it is an unsecured loans, we're the ones who set the parameters for what types of improvements can be made. We're very expansive. We allow all kinds of energy improvements, including any kind of remediation that may stand in the way of those getting work done. So, for example, if there's knob and tube wiring or something like that, that needs to be remediated before somebody installs insulation in their home, we allow them to do that, asbestos, those types of things. So what are our results? We have done about $225 million in residential lending since the beginning. So over the last 10 years, about $225 million. If you remember, our initial investment from the state of Michigan was $6 million. We also got additional money from the U.S. Department of Energy during ERA. And so we complemented that $6 million with an additional about $5 million. And we've been able to leverage that at a 30-to-1 ratio, primarily because we've been able to recycle those funds as the loans are paid off. So the default rates remain really, really low, around 2% of the overall value since the beginning of our inception. And we're really proud of the fact that we've been able to serve about 56% of the loans that we have issued over the last 10 years have been in low to moderate income households. So we've measured this by 56% have been originated in low to moderate income census tracts. What we've learned over the last 10 years, we've learned a number of things. Summarizing it in this way, the credit unions just have really stepped up to the plate. They see our loan program as consistent with their mission, and they also see it as a lead generator where they can offer other products to their new members. So we're bringing them new members. They onboard those members. They put them into their portfolio, and they offer them other products as it makes sense. So they see it as a lead generator for them. They've been great partners, too, to work with us to expand access. One of the things that the credit unions recently allowed was for landlords to be able to finance projects. So it used to be only single-family owner-occupied homes, and now landlords are able to finance as well. So rental properties are eligible. The terms have expanded over the last 10 years. We started at a 10-year term. Now they're at 15. Some are going to 25 for solar. The credit scores have loosened. The underwriting criteria have loosened a little bit. Like I said, the minimum is 600. That gets approved automatically, but each of the lenders are now taking a second look. these types of improvements have helped the cash flow equation really work for homeowners. So, the longer terms make for a lower payment. Sometimes the projects can be cash flow positive from day one. So those savings accrue from the energy bills, they accrue from day one. And after the loan is paid off, of course, those savings accrue to the homeowner's bottom line. We could not have done $225 million and growing without some kind of leverage. That loan loss reserve helped us to build a program that continues to grow and leverage that state investment and that federal investment by really significant ratio. Also, especially for us as we were first getting started, we didn't have to be those experts in financing. We could be program experts, and the lenders really bore the costs of lending and the expertise, and that was important to us as we were getting started. But what about those that don't qualify for some of this traditional credit-based underwriting? The lenders, like I said, have done a really good job, and they're continuing to build additional capacity to serve more and more people that wouldn't have otherwise qualified. And we're looking at other ways to make our financing program more expansive. Some of this might require a loss reserve, some of it may not. A couple of examples are on-bill financing. We've worked with a couple of municipal utilities to build some on-bill financing programs that only look at utility bill payment history. In those two programs in two of our cities, we do not use a loss reserve because they're able to they're able to shut off service basically if someone does not pay for their loan payment when they don't pay their utility payment. So there's no need really for the loan loss reserve. We've also built up a pilot revolving loan fund with one of our utilities for those that are ineligible for the income qualified programs. It's a very small revolving loan program that we run, and that is very, very expansive. It is for customers that are in the 200 to 300% of federal poverty level. And though there's basically no underwriting other than they cannot be in a shutoff with this particular utility. That's been a really accessible program. We're excited to look at the results of that to see how we can expand that in other areas, or we might be able to use some of that data to share with our lenders to allow them to include, to approve even more applicants than they currently do. And just as a note of how many customers we do approve, we approve around 70 to 75% of the residential applicants that come through. The rest of them are not able to get approved based on the current criteria, underwriting criteria. We're also looking at potentially adding community development financial institutions. As we, with their focus on low to moderate income communities, we think that they would be really good partners in addition to the credit union lenders. We do recognize there still is a gap in the residential market, even though we've done really well in expanding access, and we're committed to increasing programs for customers with low to moderate income and communities of color who may not qualify for energy efficiency assistance and may not qualify under traditional underwriting with our lenders. Switching gears for a moment to the commercial program, we do have a loan loss reserve for our commercial lenders. However, what we've seen is that the commercial lenders have not been as aggressive in terms of expanding their terms. Most of the lenders that we work with or have worked with have limited their terms on the commercial side only to 5 or 7 years, and they really haven't made a difference with our interest rates by putting a loss reserve in. So recently we have recruited additional lenders to our commercial program, and those lenders have not required a loss reserve, so we have not structured it. We've structured it in such a way that there is no loss reserve on our commercial program with some of our newer lenders, and we're weaning our other lenders away from that. However, having said that, there are, and just in terms of how many get approved, we have about 90% of the projects that come through, and these are for small businesses, small commercial loans, probably in the range of $30,000 to $100,000. About 90% of those are eligible under the lender's traditional underwriting criteria. So it's a very small portion that is not approved, but we will look at putting a loss reserve in place in specific instances. And I'll give you a really quick example. We had a new restaurant that was being built in the city of Detroit. It was a minority-owned business, and we really wanted to get this. It was a new kind of development in the city of Detroit. We really wanted to be able to help this business get started, and our lenders were very hesitant to offer lending to restaurants, especially after COVID. And so we were able to deploy a loss reserve there, and that helped that business get started. So we'll look at it on a case-by-case basis, but overall we see that the residential program has been much more, the lenders have been much more expansive in their offerings with a loss reserve than the commercial program. So that concludes my remarks. I hope that that was useful, and I will turn it back over to you, Jeff.
Great. Thank you so much, Mary. Really appreciate the fantastic data and your very effective ability to describe the mechanics of how this works and talk about the benefits of how this actually meets folks' needs on the ground. So really excited about all that Michigan Saves has accomplished and where you're going. So next, I'd love to turn it over to my friend and colleague, Bert Hunter from the Connecticut Green Bank. Bert is the Chief Investment Officer of the Connecticut Green Bank, the first full-scale state-level government-created green bank in the U.S., which was established in 2011. Bert leads a team of 8 clean energy finance professionals that develop innovative financing programs that have deployed $2 billion in public and private investment in energy efficiency and renewable energy. And you can read more about Bert's extensive experience and impressive career online. And now I'll turn it over to Bert.
Thanks, Jeff. There we go. Now, are you controlling the slides or am I?
You are, and I can't see. Oh, there you are. Okay, take it away.
All right, let's see. Oh, there we go. Okay, great. Well, thanks again, Jeff. Great to be here with you and Mary and Tom for this session on green banks. I agree with your introductory remarks. This is such an exciting time after 4 years of being in the wilderness. I guess I can only characterize it as such. We have so many things that are happening at the federal level right now that is really kind of hopefully giving a wind to our backs. It's finally good to just have people talking positively about what we can do, for the fight against climate change. And so the Climate Accelerator is hugely exciting and would just be tremendous for our collective progress, the work we're doing here in Connecticut and everyone else is doing across the country. And we need to make the progress we need to make concerning climate. So, fingers crossed for all of that. And, we also have the Biden administration's Justice 40 movement. It's clearly front and center now. And what I want to talk to you all about today is how our Green Bank has been stepping up in so many ways to meet the needs of underserved communities and highlight one program in particular along these lines that seeks to bolster energy justice. Jeff mentioned about our background a bit. We've been around for 10 years, formed in July of 2011, totally bipartisan in terms of the approach. And for the record, our mission statement is there. But in short, our purpose is like all green banks, which is to utilize our limited public resources to mobilize multiples of private capital investment. So we have here in Connecticut utilized $300 million of public resources that has mobilized $1.7 billion in private investment, which comes to the $2 billion that Jeff mentioned. And it's a leverage ratio of about 6 to 1. But depending on the program, can range from 3 to 1 for more project loans that we get involved with that are rather large, or to 12 to 1 in the case of the program we're going to be talking about today, or even more depending upon the structure. Amongst the three goals we have is to strengthen our communities, especially vulnerable communities in Connecticut, and we have a statutory definition of what constitutes a vulnerable community, but it's very much in line with the whole Justice 40 movement. And to that point, we have just established a goal that by 2025, no less than 40% of the investment we enable and invest will benefit vulnerable populations through both our incentive and financing programs. Today, we're at about 25% or so, so we have a little bit of ground to make up to get to that goal, but we have programs that are really keyed in to that objective. Minimizing the cost of capital that is deployed into these vulnerable communities certainly goes a long way toward achieving that goal. And one program that does this is our Smart E program. Smart E is our all-purpose clean energy financing program that does it all. It is actually was the genesis of our program was actually formed from 2 points of view. The first point of view was really Mary Templeton just spoke to. We did not want to originate and manage a portfolio of consumer loans. There are a lot of issues of consumer protection. There are a lot of servicing costs that are high. Our friends in New York at NYSERDA, they had their Green Jobs, Green New York plan. They had to use a bunch of their capital to issue those loans, and then they had to figure out a way to recapitalize their program. And then there were issues of pooling those loans, getting those loans rated. They actually were ultimately successful, but they had many struggles along the way. We did not want to hit our head up against the wall, so we chose to institute a Michigan Save-like program. The programs are quite similar in terms of the loan loss reserve aspect. We use a somewhat different approach. Instead of a first loss, we use what's called a second loss guarantee, and which means that the originating bank or credit union or CDFI takes that first loss, a certain portion of risk, and then we cover the balance of risk up to the extent of the loan loss reserve. What that has resulted in, as Mary mentioned, is that brought down the interest rates on the loans to a very accessible level for most people. As you see there on the screen, 4.5% to just inside 7%, depending upon maturity. Most of these loans are in the 7 or 10-year category, although we have loans as short as 5 years, and for solar in particular go up to 20. And the other issue was with the length of the loan. And as I mentioned, we now have up to 20 years, but it wasn't uncommon for a lot of these loans that would be unsecured, as Mary mentioned, just to be in the range of 3 to 5 years. And there's no way that these investments pay back in that short a period of time. So it's really a good product. The Green Bank here, our program is managed by Inclusive Prosperity Capital, the spin-out entity from the Connecticut Green Bank. So, and they've developed a national platform, actually, system in partnership with Michigan Saves. And so I know that if you're interested in this program, please reach out to Carrie O'Neill, Madeline Priest. I know that they would be happy to talk to you. But you can see on the slide here, it really is multi-purpose, and we even extended it to one or two of our partners wanted to do EV loans, so we extended it to that. it is really our all utility purpose program. One of our lenders is, in fact, a CDFI, if I can advance the slide here, is Capital for Change, the largest CDFI in Connecticut. Capital for Change also goes by C4C. I'll refer to them as C4C. It's a little easier to say. But really like working with CDFIs and C4C in particular. They are all about working in their community, homeowners, small businesses, a lot of social impact, affordable housing. We have a program in low-income multifamily energy loans called the Lime Loan with C4C that's been very successful and goes on today. They, like credit unions and community banks, they know their local turf. They know the struggles the families and businesses are experiencing. And at the same time, as it relates particularly to CDFIs, they are purpose-built to help, in particular, LMI families through their struggles. And we know that energy burdens loom large for these families, and that really speaks to why the Justice 40 movement was so important to us and why we established our complementary goal. So here you can see how in just less than 5 years, C4C has become our largest originator of Smart E-loans. In fact, that pie chart is a little misleading. It's actually, they've produced 35 million in loans, so over half of our program. That shows a little bit less than half, but actually a little bit over half of our loans. And 37% of their loans have actually been loans to the LMI community, as you see broken out in the slide, in terms of the income bands. But all of this success came with a cost for C4C. They had a facility to help them finance this growth. In fact, we helped them originate that credit facility, but they were rapidly outstripping what they could get out of that facility. It was undersized by at least 40%. The facility was not flexible. It only worked one way. It required amortization, and it was only about a 60-65% loan to value. So it was an excessive drain on C4C's capital and liquidity. And so it was really starting to press upon C4C's ability to keep up with the loan growth. And at the Green Bank, given that they were our largest lender, we wanted to make sure that they could keep on lending. So the solution we came to was something we call a right-sized and flexible funding solution, which you see on the slide. If hopefully it's coming in. It seems like some of the aspects of that slide are not showing up. Jeff, can you actually see some of the arrows there? They don't seem to be showing up.
I unfortunately do not see the arrows. Oh, but it does. I do see at the top right that it indicates there are animations. So if you start clicking, yeah.
Here we go. Yeah, there we go. So I'm just going to actually click these through because it will. I think there's one more. There we go. Perfect. All right. So we got to work with private capital, our partner Amalgamated Bank, to structure this more right-sized and flexible solution for C4C. And really, what it amounted to, first of all, we wanted to get the size right. $27 million was for everybody kind of an eye-popping number to put on the table. But when we talked to C4C and Amalgamated, we said, look, there are a lot of loans that they've been doing, big portfolio outstanding. Let's put down a number that will allow C4C to grow into it over the next 2 to 3 years, and so that they won't be under stress as they bring more loans on the books. The second thing we wanted to do is we wanted to up the loan-to-value ratio, meaning we wanted to make it as friendly to C4C's capital position as we could. These loans have a low default rate, somewhere in the 80 basis points range. So to have C4C put up 35% of their capital against loans that have a less than 1% annual default risk seemed to be just unnecessarily high. So when we worked this out with Amalgamated Bank, we suggested that they come in, as high as they could. They ended up at 75%. And then what we did was we went to our board with a request to lend 15% on top of that. So 75% is a typical consumer loan advance rate. If you look at securitizations that are done across an array of consumer finance transactions, 75% is pretty much the standard. Sometimes as low as 70. Some maybe you can get up as high as 80%. But so we settled on 75. We came in with 15% on top of that. So that means that C4C was able to reduce its capital investment in these loans from 35% of the transaction to 10%. That was really massive for them, and means that they were able to deploy that capital elsewhere in their system and support other things like that were not as liquid, say, as these residential energy efficiency loans are. So that really solved the problem here. It's an ongoing program. It's a multi-year revolving credit structure. So as the loans repay and as the seasonality of deployment occurs, as you know, there's a big season between the months of April through generally September or October, then it slows down. So you'll get these periods during the year where the portfolio actually contracts a bit, and then it goes up, and it contracts and goes up. So that's why we established a revolving credit facility as part of the structural element here. But we feel very comfortable with this. It's been a really good transaction for C4C, and they're just a wonderful CDFI partner, and has enabled us to really expand into that market. So that's what I have for you today to lay that out and explain it. Happy to take any questions during the Q&A period. Back to you, Jeff.
Great. Thank you so much, Bert. Love to see all the innovative work that you all are doing, as you said, particularly focused on low-income communities and finding smart ways to work with CDFIs and existing institutions that are purpose-built to drive investment into those communities. So thank you very much. And just a reminder to folks, please remember, you can submit your questions using the Q&A box, and we will address them after Tom. So next up is Tom. Tom Deo is the Chief Executive Officer of the Montgomery County Green Bank. Tom joined the Green Bank in June of 2017 as the organization's first CEO to support the Green Bank's mission to accelerate affordable investment in clean energy for the benefit of businesses and residents of Montgomery County, Maryland, just outside of Washington, D.C. So thank you so much, Tom, and take it away.
Thank you, Jeff. Really appreciate the opportunity to be on this panel and be part of this conversation with Jeff and Bert and Mary. I would just sort of say that the strength of the Green Bank is its network and the ideas in the exchange. And, every time I participate on these panels, I learn from my peers there, and we are always learning and exchanging ideas. And I applaud the Coalition for Green Capital that Jeff leads is, driving the energy of that conversation in this network and in the effort around the accelerator and bringing that to the place that it is. So thank you, Jeff, and thank you, Coalition for Green Capital. So at this point, I want to bring the conversation to how Green Bank works at a very local level. You feel for how do you look at what the local market needs are, and how do you begin to develop a product mix to meet those local needs? And I'll start by just sort of giving you a feel for what the Montgomery County Green Bank. We do function and operate only in Montgomery County, Maryland. We were established by charter by the county. But we're not an agency of the county. It established the opportunity to create and have a green bank in the county and the structure of that green bank. But we are an independent 501c3 nonprofit corporation. We have an 11-member board, 2 of which are county personnel, but the balance, including Bert Hunter, are private sector board members. We got our capital from the beginning from settlement funds from the PEPCO merger of 2 utilities, PEPCO and Exelon. That's provided us with about $18 million of capital that we can use to invest in various products. And we looked at a leverage of at least 3 to 1 from that capital. And as Jeff mentioned, the purpose of our work is to accelerate investment in energy efficiency, renewable energy, by partnering with the private sector, and that's that whole leverage component. So how do we approach it? So our first job is to find the gaps that exist in the market where investment is lacking, or it's not directed to meeting some market needs. And just like you heard Mary and Bert speak, we also have a particular focus on reaching the underserved communities. A portion of our capital is dedicated to that. Our mission includes inclusive and equitable treatment to all communities, and we're very much engaged in sort of making sure we reach it down into all communities in the county. So we look to identify the risk of the areas for the investment, and then we look to define the structures to address that risk and attract that private capital. And what I wanted to do was maybe take a look at 3 examples of how we've done that in 3 areas, for small business, for commercial solar, and for community solar. So I'll just walk through these, each example, and give you a feel for how we approach them. So on the first one, we created a product that ended up being called the Small Business Energy Savings Support Product. But, why did it come to be? Well, the situation, this really came about just a little over a year ago as COVID-19 was sort of reaching into the market, and we've been working in the commercial energy efficiency space. And what we were seeing was that many of the businesses out there were facing cash crunches at that time, and many of the contractors we were working with weren't able to move forward with jobs because the businesses were having to hoard cash in order to sort of manage them way through the pandemic. The second thing we saw was a lot of the closings in establishments or in properties in which indoor air quality was clearly going to be an important component to them reopening. And how are they going to address that? Many of them had aged systems, couldn't handle the filtration and the other components needed in order to create safe spaces for employees and customers. And then the last was at that particular time, the local utilities small business program was running out of funding for it and their low-cost incentive program. So it was a role and a place we could step in. So in a quick order of 60 days, we brought a product to the table. The gap we found was sort of needing low-cost, medium-term financing, something that the market didn't necessarily offer at the time, and that the payments needed to be flexible. They needed to deal with this cash crunch, sort of reduced, drawn-out cash flow structure. So how did we go about the solution? So we found a community development financial institution, CDFI, City First Enterprises, who we'd had a partnership with prior, done a transaction with. We reached out to them and asked if they wanted to participate in this. They saw this as a great opportunity for them also to enter the market and be responsive. They had the originating and the servicing platform that we wanted to leverage, and that we would bring our capital to the table in order to support this. So we brought in our capital. We shared that capital and risk with the CDFI, a large portion of our capital and a smaller portion of theirs. but there being the originating and servicing. And we structured a program with a loan that was up to 5 years. It was going to have a less than a market interest rate over that period in order to sort of deal with the needs of the customers out there. And we offered it in a couple forms of an interest only and a deferred interest payment option. We launched that product in the fall. We've had one closing on it. We've got about 6 more projects in the pipeline. We were a little bit early in terms of the recovery period. It's now at that point that the businesses are starting to reopen, and we're seeing more interest in needing to sort of bring financing to the table as they need to improve their spaces. So we saw the need, we saw the opportunity, we launched the product. We're probably a little bit ahead of the curve in terms of its demand, but we're now sort of seeing that demand as the pandemic is getting to the place that businesses are now having to open and those indoor spaces be made comfortable for their customers. The second program we looked at was a commercial solar program. And what we found in the situation, and this is all done through due diligence, we're talking to contractors, talking to end users, that we were learning that there were a lot of small properties out there. Montgomery County is largely a developed space, so you're dealing with a lot of rooftops. But a lot of them have small rooftop spaces that could only handle small arrays, less than 50 kW in many instances, clearly less than 100 kW mostly. And the contractors we were working with just didn't have a solution for them. It was just too costly, and they were in result avoiding the clients and not really reaching out to them or building a customer base with them because they just couldn't find a solution there. Again, these are small businesses. We found that they had cash outlay concerns. They couldn't bring a lot of capital to the table to initiate these programs, and they were highly rate sensitive. So, and then the other one we've been trying to get inroads in was within the affordable housing network, and how to help support that, which is highly capital constrained, always looking for lowest cost capital, and that's something that they could take on without adding it to a development budget. So the gap we found was there was a lack of financing to support below 50 kW arrays. There needed to be a no out-of-pocket solution that either affordable housing or these small businesses really wanted to participate in the renewable energy marketplace, but didn't really want to come out of pocket for it. And they really couldn't afford the idea of having this major escalator in thinking that their generated costs for the renewable energy were going to grow. They needed to really manage their long-term costs associated with it. So the solution we came up with is we worked with a PPA development partner and capital partner, and we brought our lower cost debt to the equation. And what we said was, look, if we bring some lower cost debt and we look at these arrays, and can we come up with a structure in which there's a power purchase agreement that would serve these arrays down to 25 kW, in which we can set a price per kW that is going to be constant over a 20-year, 25-year horizon, so that these entities could come to the table, not have any out-of-pocket, and be certain about a cost for the generated electricity over a long period. And we've been able to strike that deal with that particular PPA developer. It doesn't work in every instance. It does need to have a certain, ability to create an economical array on the roof. But we are we've had about 6 faith-based institutions and about another 6 other nonprofit institutions that find this very appealing, and we're in the middle of pricing and quite a few projects on this. But it was a solution to the equation of no out-of-pocket, have a steady cost of operating costs over a 20-25 year period, and work with private financing partners to get there. And then the last one I wanted to talk about was in the community solar arena. And in this particular one, we were very interested in how do we help work within the low moderate income area, and this is a particular program that helps solve that one. So the state had created a pilot for community solar, and it had an allocation area for that community solar that was dedicated to low moderate income subscribers. So if you had 30% LMI subscribers, you were given there was a specific allocation that you could get within the community solar pilot program. However, we found in working with developers that those low moderate income households posed a perceived turnover risk for those developers, that they didn't see them as long-term subscribers, and that turnover risk would then create a revenue shortfall as those turnovers would happen and getting a new subscriber in place. And in Montgomery County, the location options were limited. Many of them were going to be rooftops predominantly. So we had to find a solution that would work for rooftops. Simultaneously, the county also released a request for proposals for a very large brownfield site for two megawatt arrays, but they were going to be 100% low moderate income. So there was the stress on that particular project. So the gap we found was, how do we alleviate this LMI risk factor for the developers? And how do we just structure it so it's efficient for the development partners to participate in it? So the solution we came up with was, we're partnering with the solar developers and the subscriber managers, and we're approaching each one of them a bit in a bespoke way. In one instance, we're bringing subordinate debt to the equation, where we're willing to take a higher risk position alongside a senior debt in those transactions, in order that the senior debt can maximize its role, but also be protected a little bit from this downside risk of the potential LMI turnovers. We'll get a little bit better return on taking that subordinate level, but we do take a little bit higher risk position. On another transaction in which it's on a rooftop, we're bringing actually lower cost direct debt to that. And by bringing in that lower cost direct debt, we bring down the economics of that in order to allow for the low moderate income participation in the solar array. It's a smaller array, so that bringing that lower cost debt made that equation work for the solar developer in order to pull that together. So at the end of the day, we've got two megawatt solar arrays we're looking at, and we got one that's about a 300 kW array on a rooftop. All the 300 kW is going to deliver 30% low moderate income, and the 2 megawatts would be 100% low moderate income. So it's a way for us to look inside our ability to sort of fund and be malleable in order to meet the particular situation. So, at the end of the day, this is the full set of products that we've worked on and brought to the market in order to solve a variety of needs. We've got a homeowner product that solves both the energy efficiency and the renewable energy space. We've taken on commercial PACE as program administrator. We've got a commercial loan for energy efficiency that goes alongside the CPACE if the CPACE is not a desired loan. I mentioned the small business energy support, the commercial solar PPA is the one I talked about, in tailored structures, and then the community solar. So we've been working over a couple of years to bring these products to the table, and now we got a suite of products to offer that meet local needs. So with that, I'll end my presentation and turn it back to you, Jeff.
Great. Thank you so much, Tom. Really appreciate the really wonderful presentations from everybody. And we do have a few minutes left for Q&A. So if the panelists want to hop back on with their cameras so we can all engage in a discussion collectively. And we do have a few questions that have come in. And so maybe I'll just jump right in and start firing for folks. So one really good question from Miriam in California is specifically for Mary, although I'd be curious to hear the views from all the speakers, that she says, interesting that you're weaning lenders from the loan loss reserve. What is it that entices them to the program then versus just offering leases without extra steps of a program? Is it the deal flow and lead generation through affiliated contractors or other interest rate buy downs? So I think it's a really good question about sort of the pathway for weaning lenders off of the loan loss reserve mechanism.
Yeah, it is a really good question. And Miriam hits on a couple of things there. So the deal flow is definitely something that the lenders are interested in. We have our contractor outreach team that is in the field all the time, working with businesses and cities, counties, all kinds of organizations to drive demand. And so we're building a pipeline for them. So that's one thing. And then we do have interest rate buy downs on the commercial program that are supported and funded through our utilities. And so that definitely drives demand. So that's another aspect that she mentions that absolutely encourages lenders to be a part of that program.
Okay.
Yeah, and also...
yeah, Bert, please go ahead, because I know you have a similar structure.
Yeah, all of that, and they also, in our program, they benefit from an umbrella marketing effort. Our program fits under what's called Energize CT. So it's a way that the Green Bank, these banks, and the utilities and their energy efficiency programs can coexist, co-market, and be seen as one force in the market. So when rolling back the clock to when we first started back in 2012, 2010, 2011, 2012, the information out there was all over the place. You had to go to like 4 or 5 different websites to find out what was going on. It was terribly confusing for the customer, as well as contractors, to try to figure out, who was doing what, how to get financing. Do you go this place, that place? You're being sent in totally opposite directions. It was madness. So, being brought under one kind of unifying state brand, if you will, it was very good. The other thing is what I call the halo effect. And, banks like being in partnership with the Green Bank. They really see it as kind of a unifying force, and they trust us, and so they look to us as well as the utilities, for the utilities to manage, being kind of having some broad oversight over contractors as well as ourselves dealing with contractors. They don't want to deal with that. They just want to deal with their customers and deal with the financial side. So it's a good partnership that way.
Great, that makes sense. And that certainly comes up in a lot of our conversations as CGC sort of increases our dialogue with folks like CDFIs and credit unions about how something like the accelerator could support their business. A lot of it is really about the sort of ecosystem support of how do you generate demand, how do you create a origination pipeline that doesn't entirely rely on an individual small lender figuring out how to stand up an entirely new lending program. And so that sort of broader program structure and contractor management and marketing platform seems to be a big component of what drives participation in the programs. One really good question from Melissa at Self-Help. I'd love to hear more about how the program lenders handle interest rate risk as they make long-term fixed rate unsecured loans. This is an important question because this is a barrier very often for lenders to sort of extend out 10-year loans that are unsecured ultimately by any sort of guarantees. And I think anybody could take that question.
I'll step in first. Where we have the interest rates, kind of the program interest rates set right now, and they are tiered to maturity as opposed to credit risk. So it's a democratized way of approaching the market. We actually have not had any pushback over the years. Occasionally you'll get a lender or two who says, yeah, are you going to move those interest rates up? But that was when interest rates were kind of cresting out. They ultimately backed off. But a lot of our lenders, whether they're credit unions or community banks, are actually self-funding with their deposit base. So, in large measure, they are not under stress of needing to go into the market and raise market rate funds. And if you've probably looked at your CD rates lately, they're paying you maybe 3 basis points. So that's actually working out quite well for them. Pulling in these loans at 5 to 7%. So they've been doing rather well. So we actually haven't experienced that. I don't know about Mary and Tom.
I would echo what you say, Bert. But go ahead, Tom.
Yeah, I was just going to say, in our program, I was going to reflect on the commercial program. Our commercial loan program is a similarly structured loss reserve program that stands behind a commercial lender. And, they've joined the program and they said they'll go out 12 years. They'll take a 7-year on one fixed rate, and then they'll do an adjustment after 7 and fix it for the balance. But what they were really looking at was the loss reserve provided them the risk management component to it, and having a 5% loss reserve that stood behind them allowed them to take that out to that longer term, because in effect, a commercial loan portfolio has generally less than a 2 or 3% default rate. Having a 5% loss reserve cover certainly gave them the cover for the portion of the risk that they felt they were assuming on a 7 or a 12-year horizon. So.
Great. Well, amazingly, we are out of time. This went by very, very quickly. But thankfully, this can continue for folks who want to keep the conversation going. So thank you so much to our speakers, to Mary and Tom and Bert. As always, really wonderful to be together, to be able to participate in the Finance Forum. All of the, as I said before, all of the presentations are available for download. And again, if you'd like to continue exploring the topics presented today, please follow us to the Zoom chat room by clicking on the Zoom widget on your screen. So thanks again to our speakers, and hope to see a few folks over in the Zoom conversation in a moment. So thanks so much.